Hello and welcome to today's daily analysis for the 29th February 2024. So firstly, as you can see here, we're going to start with the US dollar index, which rose sharply to 104, fueled by a decline in foreign currencies influenced by the Reserve Bank of New Zealand's cautious stance. The hawkish comments from Federal Reserve officials added support. Despite a soft US GDP revision, the dollar rebounded, reaching 104.24 during the European session. The daily chart suggested the index will likely remain between 103.35 and 104.34, with optimistic remarks from the Fed officials countering weak economic data. The traders are attentively awaiting Thursday PCE inflation data for potential trading opportunities around the US dollar index, with the possibility of its breaking above 104.34, reaching 104.97. Conversely, a drop below 103.35 could lead to testing 103 and 102.9. The Fed officials' cautious approach and market expectations anticipate the first rate cut in June, shaping the current sentiment in financial markets. And for the crude oil, the prices briefly hit a 1 month high of $79.24, but retreated due to an unexpected increase in U.S. crude inventories. The uncertainty over the Israel Hamas ceasefire negotiations and the Houthi attacks in the Red Seas add the market challenges. The OPEC Plus is considering extended oil production cuts, and Russia imposed a 6 month gasoline export ban from March 1 to stabilize oil prices. The WTI crude, currently around 78.3, faces resistance at 78.67, a break above target 79.15 and 80. On the downside, watch the 200-day moving average at 77.62. A drop below it could lead to levels at 75.89 and 74.07. The market is influenced by geopolitical tensions, inventory data, and OPEC Plus decisions. And then for our gold prices, it held above 2030 on Wednesday, with 10-year US Treasury yields easing after reaching 4.3% on Tuesday. The US dollar rebounded, and markets remained calm after the Reserve Bank of New Zealand cautious stance. The traders took profits from short dollar positions and awaited directions from upcoming US economic data. Gold, following Tuesday rise, faced resistance near the 50-day moving average at 2033 and need to surpass $2,041 to resume an upward trend. The RSI indicator supports bullish potential, and surpassing 2050 challenges bearish sentiment. However, if the gold fails to stay above 2033, it may trend downwards, targeting levels at 2017.2, 2016.10, and potentially 2009.4, with the breakthrough leading to a decline towards 2000. The Australian dollar pair dropped to a 2 week low of 0.6488 due to a stronger US dollar and lack of positive data from the Reserve Bank of Australia. Ongoing concerns about potential US monetary easing and increased iron inventories are keeping the Australian dollar weak. Despite a recent rebound, the pair is still sensitive to China's economic situation, and positive news may support the Australian dollar. The Reserve Bank of Australia's cautious stance is expected to prevent significant downward pressure on the currency, as it's seen as one of the last G10 central banks to consider interest rate cuts. If the bearish trend continues, the AUD-USD pair could reach 0.65 and in the February 5th low of 0.6468. Further decline could lead to revisiting the 224 lows at 0.6442 and round number mark at 0.64. On the upside, a reversal to the 200-day moving average 0.656 and breaking through the weekly high of 0.6595 may test the 55-day moving average near 0.6626, aligning with the January 30 high of 0.6625. And then for our pound, it first fell near 1.26 but then steadied around 1.265 despite the US GDP revision. Currently trading around 1.265, the pair is on an upward trend with potential buyer focus at this level. The US dollar faced challenges on Monday, indicating a neutral risk sentiment. Although the pound is under some selling pressure, caution is advised as technical indicators on the daily chart remain positive. Technically, the pound struggled to stay above the 50-day moving average, 1.2675, and fell below the 23.6% Fibonacci retracement level. A break below 1.2664 could favor bearish traders, finding potential support around 1.26 and 1.2591. On the upside, breaking through 1.27 and 1.2709 is crucial for further testing at 1.2772 and 1.28. Despite some selling pressure, the positive indicators on the daily chart suggest caution in anticipating support and resistance levels. And then for the Japan yen, it traded steadily around 150.71 against the US dollar this week, despite earlier warnings from the Japanese authorities about possible intervention. The economic data from the United States is slightly stronger than expected. Domestic consumer inflation briefly lifted the yen midweek, sparkling speculation about the Bank of Japan's potential ending negative interest rates. However, concerns about the Japanese recession tempered confidence. The emergence of USD buying supported the pair during Wednesday Asian session, driven by expectations that the Federal Reserve will maintain higher interest rates. Technically, this week's support is at 150.07, with the potential downside towards 149.18. Sustained strength above 150.85 to 150.90 is crucial for bullish bets, targeting 151.45 and last year high near 151.91. And then for the Euro USD, it faced downward pressure, touching the multi-session lows near 1.08. On Wednesday, amid a stronger USD and cautious sentiment ahead of key data releases. Despite the US dollar index attempting gains, low US Treasury yields and recent comments from the ECB president provided some support. The currency pair remained above the key psychological level of 1.08, with a potential upward moving towards 1.09 if it returns to last week's high. On the downside, a break below 1.08 may lead to further declines, testing support at 1.076 and potentially reaching 1.07. The market is closely monitoring upcoming data releases for potential impact on Euro USD trajectory. And this is the data analysis for today. Thank you for watching. If you have any questions or want more information, feel free to reach out to us.